Hi, Bill Bodner, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. Up on the screen, I want to start with MMG, our daily that goes out to our members. And inflation, the Fed has changed their approach on inflation and how they move monetary policy. And it's important for us as mortgage bankers to understand what to look at and what's going on. So this morning we had the CPI come out, and the CPI is the Consumer Price Index. It's different than the Fed's favored gauge of inflation, which is the personal consumption expenditure, the PCE report. And so CPI right now is running at 1.7 year over year, right? And in our eyes, the Fed has said that they want inflation to run hotter and maybe sustained for some time before even considering a rate hike. And that's why firms like Goldman Sachs are saying, hey, there's no rate hike for 5 years. 1.7% in our eyes, we need to see inflation on CPI run at 3%, probably for some time before the Fed even considers a rate hike. On the other side of the coin, the PCE, which comes out in the third week of the month, that's running at 1.3%, so cooler than the 1.7. It's because the way the methodology to come up with those figures are different. So that 1.3%, we'll probably need to see more like 2.5% before the Fed starts considering rate hikes. So right now, inflation is not an issue, but it's growing. Expectations are growing. And something that you need to share with clients is you need to think like an investor. Right now, the 10-year note is yielding 70 basis points, let's call it. And we have inflation running at 1.7%. That means we have a 1% gap between inflation expectations and current interest rates. That's unsustainable. I mean, the only other time that inflation ran beneath rates was back in 2012 when during QE. So it's clear in our eyes that the Fed's involvement in the bond market has this created this topsy-turvy world. It will be unsustainable longer term. So you need to help clients understand that with inflation, expectations rising, if it continues to rise in the months ahead, there will be so much pressure on the Fed to do even more to pin down long-term rates because you have to get compensated above the rate of inflation. These are just a couple of hot months, right, that we're seeing after coming out of a very, let's call it low, depressed, lack of demand environment caused by COVID. But in the months ahead, it'll be very telling to see where inflation sits. And the last thing I'd leave you with here is that the hourly earnings that we're seeing to get people back to work, that's adding to that inflationary pressure as well. Stocks are important. The NASDAQ is flirting with its 50-day moving average. You can see it's kind of gathering here, hopefully making a bottom. If prices break beneath this in a material way, there's probably a very good chance that rates move another leg lower. The opposite is probably true. Maybe there's a limit to where rates can go because if we move higher here, money will find its way probably more into the stock market as an investment standpoint. So we need to track that. And then finally, looking ahead, next week is the Fed, right? Fed is not going to hike rates, right? But the Fed has a dual mandate, really a three-piece mandate: price stability, maximum employment, and maintaining market calm. So